Indicators of a slowing economy include increasing layoffs in the tech and banking sectors, and a decrease in discretionary spending on items such as Airbnb and cars. The Fed is fearful that they won't be able to create a soft landing at all. Since interest rates have been low for over a decade, the everything bubble will pop, taking the housing market, stock market, and bond market along with it. It's true that they can stop this collapse, but they're afraid they'll have to sacrifice the currency to do it, which in itself is another disaster. The Fed is currently stuck between a rock and a hard place, trying to balance a recession with inflation. This is one of the reasons why people are expecting a Fed pivot. Investors do not believe the Federal Reserve will choose a massive recession over skyrocketing inflation. With the troubling times ahead, investors like Jamie Dimon are expecting the Fed to hold interest rates at around 5%, trying to balance a recession and inflation. This is a form of yield curve control similar to after World War II. This, for central banks, may be the best of both worlds, but for the people, it is the worst of both worlds. The public will have to deal with a declining economy and rising prices for an extended period of time. The Federal Reserve Bank has stated that it is concerned about three issues in 2023. Firstly, inflation is not decreasing fast enough, thus dragging out the misery with high prices. Secondly, there may be a sharp decrease in asset prices, causing a reverse wealth effect. According to the bank, they anticipate inflation to be higher than initially predicted in 2023. This is significant as while high inflation has been observed in recent years, the full impact has yet to be felt by the general public. This is because people have been able to afford paying more than the suggested retail price for items such as cars and homes. Chase Bank Economic Outlook Report for 2023 also supports this sentiment. It has reported that American household finances are currently healthy when compared to historical standards. However, the savings and liquidity that were accumulated during the pandemic have been depleted throughout the year 2022. This means that while households may appear financially stable, it is due to the excess savings from the pandemic, such as stimulus and unemployment checks. According to the report, Americans had between 2 to 2.4 trillion in excess savings, which is now estimated to be between 1.2 to 1.8 trillion. The report also suggests that depending on the inflation rate and consumer spending in the coming months, this excess savings could be completely depleted by the end of 2023. However, inflation rates will remain high and prices of goods will continue to increase. Although the rate of increase may have slowed down, prices are still growing at a significant rate and are not decreasing. As savings decrease, consumers will have less ability to afford these higher prices, which will lead to a decrease in demand and further economic challenges. The Federal Reserve Bank is concerned about this inflationary problem and is working to reduce demand by increasing interest rates to bring inflation down. The Federal Reserve Bank is concerned that as the excess savings are depleted, more individuals will experience financial difficulties due to their inability to afford the high prices of goods. Additionally, the bank is worried about potential falls in the stock market and the real estate market. This is not necessarily because of the decrease in prices, but because of what it could indicate for the future of the economy. They have been working to raise interest rates to bring down inflation, but the effect of this is that borrowing money becomes more expensive, which can negatively impact businesses and thus lead to a decrease in the stock market. The concern is not just the potential decrease in prices, but also the larger implications of such a fall, especially given the current high levels of debt. For example, if an individual purchased a home for $200,000 and put down 10% and financing the remaining amount, and a year later the home value increases to $300,000, it allows them the opportunity to refinance and take out additional cash. However, if the value of the home were to decrease to $160,000, the individual would be in a negative equity position on their mortgage. When the value of a home decreases to the point where the individual is in a negative equity position, they are unable to refinance or sell their home without incurring additional costs. This is not a problem as long as the individual is still able to make payments on their debt and continue to have a stable income. However, if they lose their income or the economy slows down, they may have difficulty making payments on their debt and become stuck in this negative equity position. This is a concern for the Federal Reserve Bank, as it can lead to a further decrease in asset prices and potentially cause larger economic issues greater than 2008. The Federal Reserve Bank is worried that if individuals lose their ability to pay on their debt, It could lead to involuntary sales of assets, such as stocks and real estate, which could turn a correction into a collapse. One of the concerns is the recent increase in margin trading, which is when individuals trade and invest money using debt given to them by a stock brokerage. While it is not recommended, there has been a significant growth in margin trading in recent years due to low interest rates. According to data from the Thin website, at the end of 2022, there was approximately $640 billion in outstanding margin debt in the stock market, which is near the highest levels ever seen, even before the pandemic, except for a few months in 2018. Additionally, there is currently more housing debt than ever before, at a time when housing prices have begun to fall. Currently, the debt levels are at the highest they have ever been. Personally, I like precious metals to hedge against the collapse of nations, but let's hope I'll be wrong about the collapse. Thanks for watching.